Financial Law 2024 exam paper with answer. Question 1. Solve any 5. A. Give any 2 example of asset not covered under SURF-SI Act 2002. Example of asset not covered under SURF-SI Act 2002. 1. Agricultural land. Agricultural land is exempt under the SURF-SI Act. Banks cannot take possession or sell agricultural property even in case of loan default as per section 31(1). This protect farmers and prevent misuse of recovery power on farmland. Second, security interest in aircraft or ships. The Act does not apply to loans secured by aircraft or ships. These are governed by separate law due to their specialized nature and international regulations. B. List out any 2 objectives of corporate debt restructuring. 2 objectives of corporate debt restructuring CDR. First, to support viable companies facing financial difficulties. CDR helps viable companies facing financial difficulties. CDR help companies recover from temporary financial stress without going into liquidation. Second, to protect the interest of creditors and lenders. It aims to ensure lenders recover their dues through restructured payment plans, reducing the chances of bad loans. C. Write any 2 primary objectives of Foreign Exchange Regulation Act. 2 primary objectives of the Foreign Exchange Regulation Act FERA. 1. To regulate foreign exchange transaction in India. FERA aimed to control payments, dealing in foreign exchange and securities to maintain India's economic stability. Second, to conserve foreign exchange reserve. It focused on preventing the misuse of foreign exchange and ensuring its proper utilization for the country's development. D. Write any 2 type of person entitled to have his name in the register as per provision of Actuaries Act 2006. 2 type of person entitled to have their name in the register under the Actuaries Act 2006. 1. Associate member of the Institute of Actuaries of India. A person who qualifies as an associate can apply to have their name entered in the register maintained by the institute. Second, fellow member of the Institute of Actuaries of India. A person who attained the status of fellow having fulfilled higher professional and experience requirement is also entitled to registration. E. Define adjudicating authority under Insolvency and Bankruptcy Code. Adjudicating authority under Insolvency and Bankruptcy Code IBC 2016. The adjudicating authority is the judicial body designated to oversee and decide matter related to insolvency and bankruptcy under the IBC. For corporate person, the National Company Law Tribunal act as the adjudicating authority. For the individual and partnership firm, the Debt Recovery Tribunal is the adjudicating authority. It has the power to admit or reject insolvency application, approve resolution plan and pass order related to liquidation or bankruptcy. F. Write any 2 salient feature of SURF-SI Act 2002. 2 salient features of SURF-SI Act 2002. 1. Empowers banks to recover non-performing asset without court intervention. Banks and financial institutions can take possession of secured asset and sell them to recover dues from defaulters. Second, establishment of asset reconstruction companies. The Act allows setting up asset reconstruction companies to acquire and manage bad loans, helping in effective resolution of stressed assets. G. Give any 2 liability of guarantor during corporate insolvency resolution process. 2 liabilities of guarantor during corporate insolvency resolution process CIRP. First, coextensive liability. As per the Indian Contract Act, a guarantor is equally liable with the corporate debtor. Creditors can initiate action against the guarantor even during the CIRP. Second, independent proceedings. Insolvency proceedings can be initiated independently against the guarantor under the IBC even if CIRP is ongoing against the corporate debtor. Question 2. Answer any two questions. Explain boilerplate provisions under SERFICI Act 2002. Boilerplate provision refer to standard legal clauses commonly included in contracts and legal documents to ensure clarity, consistency, and enforceability. Under the SERFICI Act 2002, these provisions are included in loan agreements and enforcement notices to support the smooth recovery of non-performing asset by bank and financial institution. Key boilerplate clauses include: first, jurisdiction clause specifies which legal form like DRT will handle dispute. Second, notice clause details how and where official communication must be delivered. 3. Serviceability clauses ensure that if one clause is invalid, the rest of the agreement still applies. 4. Amendment clause states that changes must be made in writing and agreed by all parties. These provisions help avoid legal disputes and provide a strong legal foundation for enforcing recovery action under SERFICI Act. B. Write any 5 major features of Insolvency and Bankruptcy Code. 5 major features of the Insolvency and Bankruptcy Code IBC 2016. First, time-bound resolution process. IBC mandates the resolution of insolvency cases within 180 days, extendable to 330 days, ensuring speedy disposal. Second, unified law. It consolidates and replaces multiple laws related to insolvency and bankruptcy for corporate, individuals, and partnerships into a single framework. 3. Insolvency professionals. Trained and licensed professionals manage the debtor's affair during the resolution process to ensure transparency and efficiency. 4. Adjudicating authorities. NCLT for corporate person, DRT for individual and partnerships. These authorities handle insolvency cases under IBC. 5. Committee of Creditors COC. The COC, consisting of financial creditors, takes key decision during the resolution process, including approval of resolution plan. Question 2C. Write a note on composition of Council of Actuaries Institute. The Council is the governing body of the Institute of Actuaries of India, IAI, as defined under the Actuaries Act 2006. It manages and regulates the functioning of the actuaries profession in India. First, elected members. Up to 12 members are elected by the fellows of the institute from among themselves. Only fellow can vote and contest in this election. Second, nominated members. The central government can nominate up to 4 members to the council. This may include experts from law, finance, economics, and other relevant fields. Key points. The term of office for both elected and nominated members is 3 years. The council also elects a president and vice president from among its members. This mixed composition ensures a balanced and professional approach in managing the institute's activities. Question 3A. Assess the impact of SERFICI Act on borrowers' right and protection in the Indian financial system. Assessment of the impact of SERFICI Act on borrowers' right and protection in the Indian financial system as follows. The securitization and reconstruction of financial asset and enforcement of security interest. SERFICI Act 2002 was enacted to empower bank and financial institutions to recover non-performing assets efficiently without court intervention. While it strengthened the position of lender, it has had a mixed impact on the right and protection of borrower. Positive impact on the financial system. Faster recovery mechanism. The Act allows lenders to take possession of secured asset and sell them after giving a 60-day notice, reducing delays in recovery. Improved credit discipline. Borrowers are more cautious and disciplined about repayment, knowing that banks have stronger enforcement power. reduction in NPAs. The act serves as a deterrent for willful defaulter, helping banks clean up their balance sheet. Encouragement of asset reconstruction. The act allows for the formation of asset reconstruction companies to manage and recover bad debts efficiently. Concern regarding borrower right. Limited judicial resource. Borrowers can appeal to the debt recovery tribunal only after the bank has taken action. There is no provision for prior hearing before asset seizure. Short notice period. A 60-day notice may not provide sufficient time for borrowers to arrange repayment or defend their case. One-sided enforcement power. The act heavily favored lender, often overlooking the borrower's genuine financial default difficulties or procedural lapses by bank. Impact on MSMEs and small borrower. Many small businesses face hardship due to strict recovery action. Although agricultural land is excluded, small entrepreneurs may lose vital asset. No provision for debt restructuring. The Act does not focus on rehabilitation of borrowers, particularly those in temporary financial distress. Judicial safeguards and evolving interpretation. Courts have tried to maintain balance by interpreting the Act in favor of natural justice. For example, in the Merida Chemical Limited case 2004, the Supreme Court ruled that borrower must have a fair chance to be heard. Borrowers can challenge bank action in DRT and DRAT through these forums are often overburdened and delayed. Conclusion. The SURF-SI Act has significantly improved the efficiency of the banking sector in dealing with bad loans. However, it has also raised concern about borrowers' right, fair treatment, and due process. Going forward, there is a need to strike a balance between the interest of lender and the rights of borrower by improving transparency, grievance redressal mechanism, and restructuring support for genuine cases. Question 3b. Judge the societal and economic implication of SURF-SI Act on our credit ecosystem in India. Judging the societal and economic implication of the SURF-SI Act on the credit ecosystem in India. The SURF-SI Act 2002 was enacted to address the rising issue of non-performing assets and improve the health of India's banking system. It allows banks and financial institutions to recover their dues without the intervention of courts, significantly altering the credit ecosystem in India. Economic implications. Strengthened banking sector. The Act improved the asset quality of bank by enabling faster recovery of loans, thereby reducing NPAs and improving financial stability. Increased credit confidence. With strong legal backing, lenders become more confident in extending credit, knowing they could enforce security interest efficiently. Growth of asset reconstruction market. The Act promoted the establishment of asset reconstruction companies, which help banks clean up balance sheets and revive distressed assets, improved investor sentiment. A strong recovery framework improved the credit rating of Indian Bank and attracted foreign investment in the financial and distressed asset sector. Societal implications. Pressure on genuine borrower. The Act gave banks sweeping power, sometimes affecting small borrower and MSMEs who may default due to temporary financial issues. Limited legal protection for borrower. Borrowers often have a approach debt recovery tribunal DRTs only after recovery proceeding begin, which weakens their defense opportunities. Exclusion of agricultural land, a social safeguard. The exclusion of agricultural land under Section 31 of the Act protect farmer from forced recovery, which is a socially responsible provision. Encourage financial discipline in society. The possibility of losing asset has encouraged more responsible borrowing behavior, reducing willful default and promoting credit discipline. Potential social tension. In some cases, harsh recovery actions have led to public protest and distress, especially when small business assets or homes are seized. Balanced view. When the act has helped clean up bank book and boost the economy, there is an urgent need to balance creditors' right with borrower protections. This includes strengthening borrower grievance mechanism, fast-tracking DRT cases, promoting debt restructuring for viable businesses. Conclusion. The SURF-SI Act has had a transformational impact on India's credit ecosystem. Economically, it empowered lenders and strengthened the banking sector. Socially, it brought discipline but challenges for vulnerable borrowers. Going forward, a balanced approach is essential to ensure both financial stability and social justice. Question 4a. Describe the different methods of strategies used in corporate debt restructuring. Corporate debt restructuring (CDR) is a mechanism used to restructure the debt of companies facing financial distress with the goal of making their debt more manageable and avoiding insolvency. Previous strategies can be employed depending on the company's condition and creditors' willingness. First, rescheduling of loan repayment involves extending the payment period and modify the installment schedule. Help reduce immediate cash flow burden on the company. Second, reduction in interest rate. Creditors may agree to lower the interest rate on existing loans. This reduces the overall cost of borrowing and eases financial stress. 3. Conversion of debt into equity. A portion of the debt is converted into equity shares, making lenders shareholders. Reduce debt burden and aligns lender interest with the company's success. 4. Debt haircut. Write-offs. Creditors may agree to forgive a part of the debt, especially when recovery chances are low. This helps the companies survive and continue operation. 5. Fresh funding. Sometimes additional loans are provided to help the companies overcome short-term liquidity crisis. Fresh funding may come with strict term and monitoring. 6. Changes in management or promoter stake. In certain cases, restructuring may involve change in management control to ensure better governance and future viability. 7. Asset sale or divestment. The company may be advised to require to sell non-core asset to repay debt and reduce operational cost. 8. Merger and amalgamation. In some cases, debt restructuring is achieved through merger with financially stronger firm, this ensuring business continuity. Conclusion. Corporate debt restructuring strategies are designed to ensure business revival while protecting creditors' interest. A successful CDR process balances the financial need of the company with the recovery goal of the lender, helping avoiding legal insolvency proceedings and preserving economic value. Question 4b. Evaluate the effectiveness of strategic debt restructuring in addressing systematic issues related to non-performing assets in the banking sector. The Strategic Debt Restructuring (SDR) scheme was introduced by Reserve Bank of India in 2015 as a mechanism to empower banks to convert bad loans into equity and take control of defaulting companies. Its objective was to resolve stressed assets and reduce the growing burden of non-performing assets in the banking sector. Objective of SDR: to enable lenders to change management of defaulting companies, to convert outstanding debt into equity and sell the stake to new promoter, to ensure better accountability and revival of defaulting companies. Effectiveness. First, empowerment of lenders. SDR gave bank the power to remove inefficient promoter and take over companies. It addresses the root cause of some NPAs are poor corporate governance and promote failure. Second, initial enthusiasm but limited success. Though Many cases were approved under SDR, only a few resolutions were successful. Banks struggled to find new buyer or investor to take over restructured companies. 3. Operational and legal challenges. Converting debt to equity led to banks holding large stakes in companies, which banks were not equipped to manage. There were delays in implementing due to regulatory clearance and lack of interest from new promoter. 4. Limited impact on overall NPA reduction. The SDR mechanism failed to make a significant dent in overall NPAs. It often delayed recognition of bad loans rather than solving them. 5. Transition to IBC framework. With the introduction of Insolvency and Bankruptcy Code in 2016, SDR lost relevance. IBC proved to be more structured and legally effective for NPAs reduction. Conclusion. While strategic debt restructuring was a bold and intuitive attempt to tackle NPAs by giving banks more control, it faced serious execution hurdles such as a poor buyer interest, lack of promoter accountability, and the absence of operational capacity in banks. Eventually, it has superseded by more robust framework like IBC, which offered better legal clarity, timelines, and resolution outcomes. Hence, the overall effectiveness of SDR was limited and it served more as a transitional strategy than a long-term solution to systematic NPS issues. Question 5a. Summarize the main objective of FEMA and how it differs from FERA in terms of regulation and administration. Foreign Exchange Management Act FEMA 1999. FEMA was enacted, replaced by the Foreign Exchange Regulation Act FERA 1973 and came into effect from June 1, 2000. Main objective of FEMA. First, facilitate external trade and payments. FEMA aims to promote and order development and maintenance of the foreign exchange market in India. Second, liberalize foreign exchange control. It focuses on managing rather than strictly regulating foreign exchange dealings. 3. Promote foreign investment. FEMA create a legal framework that is more investor friendly, attracting FDI and promoting globalization. 4. Ensure balance of payment stability. It helps maintain the economic stability by monitoring capital flows. 5. Encourage transparency and simplicity. FEMA uses civil law provision rather than criminal promoting ease of doing business. Nature of law, FERA, regulatory and restrictive, 1973. Nature of FEMA, management oriented and liberal, 1999. Approach of FERA focused on control of forex. Approach of FEMA focused on facilitation of forex trade. Presumption of guilt, FERA, accused was presumed guilty. Presumption of guilt, FEMA, accused by presumed innocent. Type of offense, FERA, criminal offense, and types of offense, FEMA, in civil offense. Penalty in FERA is imprisonment. Penalty in FEMA is monetary penalty. Objective of FERA was protect forex reserve and objective of FEMA is develop and maintain forex market. Administrative body of FERA was enforcement director strict power and administrative body of FEMA is RBI and Directorate of Enforcement Limited. Conclusion. FEMA reflects a modern liberal economic framework suitable for globalized economy. Unlike the rigid and punitive FERA, FEMA encourages ease of transaction, investor confidence and legal clarity, aligning with India's liberalization policies. Question 5b. Define Quality Review Board. Under the Actuaries Act, elaborate procedure, terms and condition of chairperson and member of board. Definition and details of the Quality Review Board under the Actuaries Act 2006. Definition: the Quality Review Board QRB is constituted under Section 29A of the Actuaries Act 2006. It serves as an independent oversight body to review the quality of services rendered by members of the Institute of Actuaries of India and promote excellence in actuarial services. Objective of the Quality Review Board: first, review the quality of actuarial services provided by members of the institute. Second, guide members to improve professional standards and quality assurance. 3. Recommend best practices for services provided in compliance with regulations and code of conduct. Composition of the board: as per the Act, the QRB consists of a chairperson and not more than 10 other members. Members are appointed by the central government. Structure: chairperson, a person of eminence with experience in finance, law, or administration. 5 members nominated by the central government from various fields like law, finance, insurance, etc. and 5 members nominated by the Council of the Institute of Actuaries of India from among its members. Terms and conditions: appointment and tenure. The tenure of the chairperson and member is determined by the central government. They can hold office for a period as specified in the appointment order, generally for 3 years or as notified. Remuneration: the honorarium, allowances and other terms of services are also decided by the central government. Resignation and removal: members can resign by writing to the central government. They can be removed for misconduct, incapacity or other reason as per rules laid down by the government. Procedure of functioning: meeting: the QRB hold meetings at interval decided by the chairperson. Review process: random or scheduled reviews of actuarial work, reports and practices. Evaluation of adherence to standard of practice and ethical guidelines. Reporting: the QRB submits its finding and recommendation to the Council of the institution and central government. Follow up: the institute may be directed to take steps based on the QRB's feedback to improve quality. Conclusion: the Quality Review Board is a vital component of regulatory oversight in the actuarial profession. It ensures that members uphold high standard of practice, thereby strengthening public confidence in actuarial work and supporting transparent and ethical governance in the financial and insurance sector. Another question paper for financial law. Question 1. Solve any 5. A. What is the maximum period allowed to be scrutinized company for recovery of reconstructed financial asset? 4 years. What time period is to given to the borrower as a notice before sale of the secured asset? 30 days. C. SDR stands for Strategic Debt Restructuring. D. The SDR conversion package must be approved by the JLF within dash days from the date of deciding the undertake. SDR is 90 days. FERA consists of Section 80. Who are the member of Institute of Actuaries of India, Associate and Fellows? Who gave the regulator under the Insolvency and Bankruptcy Code in India? Answer is Insolvency and Bankruptcy Board of India. Solve any 2. Question 2. A. Differentiate between corporate debt restructuring and strategic debt restructuring. Corporate debt restructuring. Purpose: to help companies that are facing financial difficulties but are still viable to combine operating. Purpose of strategic debt restructuring: to help banks recover their loan from companies that are in financial distress and are unlikely to be able to repay their debt. Mechanism of CDR: a voluntary process that is initiated by the company and involves the participation of its creditors. Mechanism of SDR, a mandatory process that is initiated by banks and involves the participation of the company and its other creditors. Outcome of CDR, the company may be able to avoid bankruptcy and continue operating, but it may have to make significant changes to its operations or structure. Outcome of SDR, the company may be able to recover their loan in full or in part, and the company may be restructured or sold to a new owner. Purpose of CDR, to help companies that are facing financial difficulties but are still viable to continue operating. Purpose of SDR, to help bank recover their loan from companies that are in financial distress and are unlikely to be able to repay their debt. Initiation of CDR is voluntary. Initiation of SDR is a mandatory. Participation of CDR in company and creditors. Participation of SDR in company, creditors and banks. Outcome of CDR is company may be able to avoid bankruptcy, and outcome of SDR is banks may be able to recover their loan. Question 2b. Explain about the incorporation of Institute of Actuaries of India. The Institute of Actuaries of India was incorporated on September 1st, 1994 as a non-profit society under the Registration of Societies Act 1860. The IAI was established to promote the science of actuarial science and to regulate the profession of actuaries in India. In 2006, the Actuaries Act 2006 was passed by the Parliament of India, which established the IAI as a statutory body. The IAI is now a sole professional body for actuaries in India. The IAI is responsible for setting the standards for actuarial education and training, conducting examination and awarding the designation of Fellow of the Institute of Actuaries of India. The IAI also provides a number of other services to members such as continuing professional development, networking opportunities and advocacy on behalf of the actuarial profession. The IAI is governed by a council which is elected by the member of the institute. The council is responsible for the overall management of the IAI and for ensuring that the institute meets its objectives. The IAI has headquarters in New Delhi in India. The IAI also has number of regional offices located across India. The IAI is a member of the International Actuarial Association, which is the global body of actuaries. The IAA represents over 150,000 actuaries in over 100 countries. The IAI is committed to promoting the highest standard of actuarial education and practices in India. The IAI is also committed to serving the needs of its members and to advocating on behalf of the actuarial profession. Some key objectives of the IAI: first, to promote the science of actuarial science; second, to regulate the profession of actuaries in India; third, to set the standard for actuarial education and training; four, to conduct examination and award designation of FIA; 5. To provide number of other services to its members. 6. To advocate on behalf of the actuarial profession. Question 2c. Write a short note on securitization and reconstruction. Securitization and reconstruction are two processes that are used to manage non-performing assets in the financial sector. Securitization is the process of converting illiquid assets into marketable securities. This is done by pooling together a group of assets such as a loan and then issuing securities that represent ownership of the pool of assets. The securities are then sold to investors who receive payment based on the cash flows generated by the underlying asset. Reconstruction is the process of restructuring a company that is in financial distress. This may involve selling assets, reorganizing the company's operation, or injecting new capital into the company. The goal of reconstruction is to make the company viable again so that it can repay its debts and continue operating. Securitization and representation are both important tools for managing NPAs. Securitization can help to reduce risk of NPA by covering them into marketable securities that can be sold to investor. Reconstruction can help to turn around companies that are in financial distress and make them viable again. The Securitization and Reconstruction of Financial Asset and Enforcement of Security Interest Act 2002 SURF-SI Act provides a legal framework for securitization and reconstruction in India. The SURF-SI Act gives banks and financial institutions the power to take possession of assets that are secured by a loan and to sell those assets to recover the loan amount. The SURF-SI Act also allows banks and financial institutions to restructure companies that are in financial distress. Securitization and reconstruction are complex processes that require careful planning and execution. However, they can be effective tool for managing NPAs and improving the financial health of the banking system. Here are some of the benefits of securitization and reconstruction. They can help to reduce the risk of NPAs. They can help to turn around companies that are in financial distress. They can improve the financial health of the banking system. Some challenges of the securitization and reconstruction are as follows. They can be complex and time consuming processes. They can be expensive. They may not be suitable for all NPAs. Overall, securitization and reconstruction are important tools for managing NPAs and improving the financial health of the banking system. However, they are complex processes and require careful planning and execution. Question 3. A. Why there is a need for scheme for sustainable structuring of stressed asset and what are the pros of S4A scheme? The scheme for sustainable structuring or stress asset S4A scheme was introduced by the Reserve Bank of India in 2016. The S4A scheme was introduced to address the problem of non-performing asset in the Indian banking system. NPAs are loans that have not been repaid by borrower for a period of time. NPAs can have a significant impact on the financial health of banks as they can lead to losses and reduce the amount of capital that banks have available to lend. The S4A scheme provides a framework for banks to restructure NPAs in a sustainable manner. The scheme allows banks to acquire equity in stress asset which can help to improve the financial viability of the asset. The scheme also allows banks to convert NPAs into optionally convertible debentures which can provide banks with additional repayment options. The S4A scheme has a number of potential benefits including it can help to reduce the level of NPA in the banking system. It can help to improve financial health of banks that can help to revive stress asset and create job. It can help to promote financial inclusion. The S4A scheme has been welcomed by the banking industry and it is expected to play a significant role in addressing the problem of NPAs in India. Here are some of the pros of the S4A scheme. It provides a framework for banks to restructure NPAs in sustainable manner. It allows banks to acquire equity in stress asset which can help to improve the financial viability of the asset. It allows banks to convert NPAs into OCDs which can provide banks with additional repayment options. It is expected to help to reduce the level of NPAs in the banking system. It is expected to help to improve the financial health of banks. It is expected to help to revive stress asset and create jobs. However, There are some challenges associated with S4A scheme, such as it can be complex and time consuming process, it can be expensive, it may not be suitable for all NPAs. Overall, the S4A scheme is positive step toward addressing the problem of NPA in India. However, it is important to note that the scheme is not silver bullet and it will take time and effort to see the full benefit of the scheme. Question 3b. What are the circumstances under which liquidation of corporate may take place? First, insolvency. A company is insolvent if it is unable to pay its debt when they are due. This is the most common reason for liquidation. Second, bankruptcy. Bankruptcy is a legal proceeding that is initiated by the company that is insolvent. The purpose of the bankruptcy is to allow the company to recognize its finances or to be liquidated. 3. Voluntary liquidation. A company may decide to liquidate voluntarily if it is no longer viable. This may be because the company is facing financial difficulties or because the shareholders have decided to sell the company's asset. 4. Compulsory liquidation. A company may be liquidated compulsorily if it is ordered to do so by a court. This may happen if the company is insolvent or if it has committed to breach of the Companies Act. The process of liquidation is governed by the Companies Act 2013. The process starts with the appointment of liquidator, who is responsible for winding up the company's affairs and distributing its assets to its creditors and shareholders. The liquidator will sell the company's asset and use the proceed to pay off the company's debt. Any remaining asset will be distributed to the shareholder. Liquidation is a complex process and it is important to seek professional advice if we are considering liquidating a company. Some of the consequences of liquidation. First, the company is dissolved. Second, the company's assets are sold. Third, the company debts are paid off. 4. Any remaining asset are distributed to the shareholder. Liquidation can have a significant impact on company's shareholder and stakeholder, including the company's employee, creditor, shareholder. It is important to consider all of the consequences of the liquidation before making a decision to liquidate a company. Question 4a. Analyze the following scenarios with respect to registration under SPPU Act. First, eligible NBFC with debt amounting to less than rupees 50 lakh. Second, eligible NBFC with debt amounting to more than rupees 50 lakh. 3. NBFC not falling under the definition of financial institution but the debt amount to more than rupees 50 lakh. 4. The creditor is an operational secured creditor. And 5. The borrower is not corporate body. Here is an analysis of the scenario with respect to registration under the SPPU Act. Scenario 1. An eligible NBFC with debt amounting to less than rupees 50 lakh is not required to register the security interest with Central Registry of Securitization Asset Reconstruction and Security Interest. Scenario 2. An eligible NBFC with debt amounting to more than rupees 50 lakh is required to register the security interest with CERSAI. The scenario 3. The NBFC that does not fall under the definition of financial institution but debt amount to more than rupees 50 lakh is required to register the security interest with CERSAI. Scenario 4. An operational secured creditor is to creditor who has provided financial assistance to the borrower for the purpose of carrying on its business. Operational secured creditors are required to register the security interest with CERSAI regardless of the amount of the debt. Scenario 5. If the borrower is not corporate body, the security interest is not required to register with CERSAI. Question 4b. Analyze the function of RBI under the Foreign Exchange Management Act FEMA. Define person resident in under the FEMA. Issuing license and permit. The RBI is responsible for issuing license and permits to entities that want to undertake foreign exchange transaction. This include banks, non-banking financial institutions and corporates. Monitoring and enforcing compliance. The RBI is responsible for monitoring and enforcing compliance with FEMA. This include ensuring that entities are not undertaking foreign exchange transactions that are permitted under the Act. Administering foreign exchange reserve. The RBI is responsible for administering India's foreign exchange reserve. This include investigating the reserve and managing the foreign exchange market, providing foreign exchange liquidity to the market, providing guidance and advice. The RBI provides guidance and advice to entities on foreign exchange matters. This include providing information on the Act, the regulation and the procedure of undertaking foreign exchange transaction. The RBI also has a number of other functions under FEMA such as setting the exchange rate. The RBI is responsible for setting the exchange rate for the Indian rupee. Overseeing the foreign exchange market. The RBI oversees the foreign exchange market to ensure that it is functioning smoothly and efficiently. Promoting international trade and investment. The RBI promotes international trade and investment by facilitating foreign exchange transaction. Person resident in India under FEMA. A person resident in India is defined under FEMA as a person who is domiciled in India or a person who has stayed in India for a period of not less than 182 days during the preceding financial year, or a person who has a place of residence in India and who has been staying in India for a period not less than 182 days during the preceding financial year. The definition of person resident in India is important because it determines whether a person is subject to provision of FEMA. For example, PRI are required to obtain permission from RBI before they can undertake certain foreign exchange transaction. Question 5a. Enumerate the law for setting up offices and branches abroad. Foreign Exchange Management Act (FEMA) is the primary law that governs foreign exchange transactions in India. The act regulates the inflow and outflow of foreign exchange, and it sets the procedures for setting up offices and branches abroad. Companies Act 2013. The Companies Act 2013 is a primary law that governs the incorporation and operation of companies in India. The Act set out the requirement for setting up the branches or offices in abroad, and it is also govern the activities that a company can undertake in a foreign country. Reserve Bank of India guidelines. The RBI has issued a number of guidelines on setting up offices and branches abroad. These guidelines provide under further detail on the requirement of FEMA and the Companies Act 2013. The specific law that apply to setting up an office or abroad will depend on the company where the office or branch is being set up. In addition to the law mentioned above, there may be other law that apply, such as the law of the country where the office or branch is being set up. Here are some key requirements for setting up offices and branches abroad. Approval from the RBI. The RBI approval is required for setting up a branch or office abroad. The RBI will consider a number of factors when granting approval, such as the nature of the business, the financial strength of the company, and the risk to the Indian economy. Registration with register company. The company must register the branch or office with the Register of Companies in India. The registration process will vary depending on the state where the branch or office is being set up. Obtaining a visa or work permit. If the company is setting up a branch or office in a foreign country, the employees who will help working at the branch or office will need to obtain a visa and work permit from the foreign government. The process of setting up offices and branches abroad can be complex, time consuming. It is important to seek professional advice to ensure that the process is completed correctly and that the company complies with all applicable laws. Question 5b. Evaluate the bankruptcy process of individuals and partnership firm. The bankruptcy process for individual and partnership firms in India is governed by the Insolvency and Bankruptcy Code 2016. The IBC provide a framework for resolving an insolvency of individual and partnership firms, and it aims to protect the interest of creditors and debtors alike. The bankruptcy process for individual and partnership firm under the IBC can be divided into two phases. First, insolvency resolution process. This phase is designed to help the debtor recognizes its finances and emerge from bankruptcy. The insolvency resolution process is supervised by an insolvency professional who is appointed by the adjudicating authority. The insolvency professional will work with the debtor to develop a plan to repay the creditor. If the plan is approved by the creditor, and the debtor will be able to emerge from bankruptcy. Second, liquidation process. If the insolvency resolution process is unsuccessful, the debtor will be liquidated. The liquidation process is also supervised by an insolvency professional who will sell all the debtor's assets and distribute the proceeds to the creditors. The bankruptcy process for individuals and partnership firms under the IBC is a complex and time consuming. However, the IBC provides a fair and transparent framework for resolving the insolvency of individual and partnership firms, which can help to protect the interest of both creditor and debtor. Here are some key features of the bankruptcy process for individuals and partnership firm under IBC. Debtor in possession. The debtor remain in possession of its asset during the insolvency resolution process. This gives the debtor the opportunity to recognize its finances and emerge from bankruptcy. Creditors Committee. A creditors committee is formed during the insolvency resolution process. The creditors committee represent the interest of the creditor and play a role in approving the insolvency resolution plan. Adjudicating authority. The adjudicating authority is a court that oversees the bankruptcy process. The adjudicating authority has the power to approve or reject the insolvency resolution plan and to order the liquidation of the debtor. The bankruptcy process for individuals and partnership firms under the IBC is a significant improvement over the previous system and bankruptcy law in India. The IBC provides a fair and transparent framework for resolving the insolvency of individual and partnership firm, which can help to protect the interest of both creditors and debtors. However, there are still some challenges with the bankruptcy process under the IBC. For example, the process can be complex and time consuming, and there is a lack of awareness of the law among debtors and creditors. Overall, the bankruptcy process for individual and partnership firms under the IBC is a step in the right direction. However, there is still some challenges that need to be addressed in order to make process more effective. Thank you so much.